when one is investing in equities, one is not investing in a ticker or a piece of paper. One is investing in the business that that equity represents. That business has a certain value as on a given point in time, and the price of that stock hovers around that value.
So today we have amongst us Mr. Anshul Saigal, who is the portfolio manager with Kotak Special Situations and Value PMS. I think this is one of the best PMSs over the last 5 years in terms of its performance. Though it has been volatile, but at the end of the day, performance over the last 5 years has been very good. So we would like to understand from you, what has been your investment philosophy, and as the name says, special situation, value and special situations. So over to you. We'd like to understand from you.
Thanks, Kamal. Thanks for coming and doing this interview. It's equity investing is really much more of an emotions play than one gives credit to it. Markets work in their own fashion, so expecting the markets to go up in one unidirectional way is something that is our expectation as investors, but markets don't pander to our expectations. They operate in their own fashion, and that fashion is to go up and go down and then go up again. And this is the way it has been happening over the last 100 years. So we as market participants have to adjust to this way of the market functioning. And hence, to adjust to that, it requires us to have control over our emotions. And so, the first thing that one has to understand when one is investing in the markets is that markets will remain volatile. They have been volatile forever. They will remain volatile. Any belief that the markets are going to have a reduced volatility and one-sided moves is going to disappoint our expectations. Having said that, what one has to also keep in mind is that when one is investing in equities, one is not investing in a ticker or a piece of paper. One is investing in the business that that equity represents. That business has a certain value as on a given point in time, and the price of that stock hovers around that value. So say the value is 100 and the price by virtue of the market participants being bullish on that name is 110, you will obviously not have the right risk reward in investing in an opportunity like this, because something that is worth 100, you are paying 110 for that asset. Similarly, if that asset is worth 100 and you're paying 90 for it, you have some amount of value that is accruing to you when you're investing in that name. In our investing philosophy and in the special situations and value strategy, as the name suggests, we are looking for value opportunities. We are looking for those transactions or sort of opportunities where we are buying into an asset which is worth 100, but it trades at 50, 60 or 70 rupees by virtue of a misassessment of the market, which is temporary. And as that misassessment goes away, this 50, 60, 70 moves to 100, and we make risk-adjusted returns which are favorable. How we do this is that, of course, we invest in, there are three broad categories of investments that we do, or opportunities that we invest in. One is statistically cheap names. These may be companies which are not really very attractive as business models, but they have an element of a discount to their intrinsic value, which we understand why that discount exists, and we also understand what the triggers for that discount are going to be, for that discount narrowing are going to be. If we understand that, we invest in these names, and these are one-off trades. When the value unlocking happens, we are out of these names. The second set of opportunities are companies which are economic moats. And economic moats is a term which has been coined by Warren Buffett. What he essentially means by that is that these are companies which have some amount of competitive advantage, which leads to these companies consistently generating high returns on capital. Now, these competitive advantages can be in various forms. If a company has a brand, by virtue of it having a brand, it has pricing power. So, say Pearl soap. Pearl soap can keep raising the price of that soap by virtue of the brand being Pearl's and the consumer having a connect with that brand. So, if the soap did not have Pearl's and you were just selling the soap, you would not give extra money for that soap, because you would say that there are so many soaps which are unbranded in the market, I could buy those. Why should I pay 1 rupee extra? But for a Pearl soap, you won't really mind paying that 1 rupee extra because you are connected to Pearl's as a brand. Hence, brand is a competitive advantage which gives you pricing power. And if you can price your product higher than competition, your return on equity also goes up. Second, you have the element of a distribution network. A distribution network gives you a significant competitive advantage versus someone who doesn't have a distribution network, because you can reach areas where your competition can't. And as a result of that, your sales move up, and that gives you as I said, a competitive advantage. Third, if you have lower costs, that again gives you a competitive advantage. I mean, in the airline industry, for instance, Indigo having the lowest cost structure allows it to have probably a safer business model than many of the other players, because downsides to that extent are limited. It can weather storms in that airline industry. As also many other names, which have a, say in the cement sector, if you have a lower cost structure, it allows you to have higher ROEs in a commoditized business. Again, a very big positive advantage that you have if you have a low cost structure. So through these sort of, I'm just giving you instances that these are some instances through which you can have economic moats. And we are seeking such companies which have economic moats and which are trading at reasonable valuations. Because if they keep compounding capital, that compounding of capital will reflect in their valuations, which is what we are seeking.
Okay.
Third type of opportunities that we are looking for are special situations, and these are largely in the category of corporate restructurings. Corporate restructurings as in demergers, asset sales, IPO of a subsidiary, things like that, which offer us opportunity to unlock value. I'll give you an instance. Heritage Foods, about 11-12 years ago, had invested in the retail business, while their core business was dairy. Now, when they invested in the retail business, they deployed additional capital there, and the retail business for the longest time kept generating losses. Now, what that did is the capital base inflated and profitability compressed. So ROEs for the company looked very compressed. Now, sometime in the year 2015, I think, they decided that they're going to demerge the retail business and sell it off to someone who's in that business. Now, as they did that, and we anticipated this, that as they demerge and they basically sell this business out, what will happen is that the core ROE of the dairy business will start looking much more attractive than what it was trading at earlier. And as ROEs move up, the valuations of this company, which were at about 10 times price to earnings or even less, will not remain there, because ROEs at 30-35% are very attractive, and this company had sort of FMCG characteristics. So valuations will expand. Stock was up 5 times as a result of this transaction of getting out of the retail business. Such corporate restructurings or special situations are what we seek. And there are many other types of opportunities. I won't dwell into too many of those, but there are many other types that one would invest in. Net, these are the 3 categories of investments that we would make. And we very clearly have delineated that these are the opportunity sets that we will stay in, and we don't look outside of this set at all. We will contain ourselves to this opportunity set and invest here.
Right. Would you like to share with us, few examples of certain stocks that you would have exited in the past? Why you entered, at what level and what cues you decided to exit, and what has been the performance in those exit. So
we were investors into, for instance, Chambal fertilizers. Now that company, for nearly a 6 to 7 year period, traded in the band of 60 to 65 rupees for as long as that. Sometime in early November, late October of 2016, we invested in the company, and our core thesis there was that the company is going out and expanding capacity in its core business, which is urea, but it has 3 non-core businesses: shipping, textiles, and IT services, where it had deployed capital and it was losing money. Now, to expand and to spend about $1 billion to expand into the core business, they would obviously need to release capital from the non-core businesses. And our assessment was that that will happen again through either an asset sale of the non-core businesses or just a plain demerger where they don't have to fund the growth of those businesses. And since the company was trading at about 6 times price to earnings, between 5 and 6 times, while competition traded, other urea companies, pure play urea companies, traded at anywhere between 10 and 15 times. It told us that one of the leaders in the urea space was trading at a discount because it had non-core businesses and ROEs as a result were depressed. Now, any sale of the non-core business will unlock value for this name. And the sale was imminent because they were investing in the core business for which they required capital. The second thing we realized is that there were reforms that were happening in the sector which were unprecedented. There was, for example, direct benefits transfers which were going to be done to farmer accounts, which would reduce working capital requirements of these urea companies. There was a neem coating which was to be done in urea, and as a result of that neem coating, there would be about a 5% realization increase for most of these urea companies. That again would enhance the return on equity and profitability structure. So we invested in this company knowing that there is actually no downside in this name since it's trading at trough valuations. And if any of these things happen, upsides could be meaningful. Our purchase would have been somewhere in the region of 60 to 65 rupees. And as the company sold out these non-core businesses, the stock rallied all the way to about 150 odd rupees. Somewhere in this journey, we sold out of this name, and pocketed the capital. It was an interesting bet to have invested in, and we enjoyed the journey.
So you entered at an attractive valuation, seeing that there could be turnaround in the business because of certain right decisions being taken, and exited, at right time.
Absolutely.
Great. So, Anshul, I would also want to understand from you, of late, what has happened that in the asset management industry, a lot of boutique firms have come up, and they have started their own PMS products because many investors are showing interest in the PMS as a category. Maybe because mutual funds are attracting a lot of retail flows, where retail flows could lead to certain behavioral biases, behavioral decisions, right, which may be forceful. But in case of PMS, it is a customized portfolio which is created for each and every client. So one client's behavior doesn't lead to the decisions taken in the other client's portfolio. So, but PMS as a category is relatively less regulated. Mutual fund is more regulated. So where do you see PMS as a category evolving over next 5-10 years?
In the markets, there is room for different types of products. So there are clients who want, I'd say, products which are managed for their own requirements, or these are managed accounts in a sense, which is what the PMS offers. It also gives them clients the access to the portfolio manager much more than that would be the case in some of the other equity asset classes, and that is what a client desires, particularly a client who's a high net worth individual and who requires that level of sophisticated understanding of his portfolios. So to that extent, this as a product is something that is going to go from strength to strength by our assessment. And equity as an asset class in India is only scraping the surface. The upside in equity flows into the country, as also from within locals investing in equities, is going to be so substantial that we are only just seeing the tip of the iceberg. There is going to be significant equity flows, and there is room for all asset classes, all types of equity products in the country. Somebody who wants off-the-shelf standardized products, he would want to invest in some of those kinds of products. Somebody who wants thematic products would want to go to other asset managers or product types, and so there will be a whole host of products which will be on offer, and there is room for every product in equities.
So when anyone would like to evaluate Kotak's special situation and value PMS, so what is it that one should keep in mind in terms of expectations, in terms of time horizon?
Anybody, whenever I talk to my clients, I tell them that if you need quick money or you need returns over the next 1 year, don't come to us, because that isn't something that we can promise you at all. What we would want to bring out to our clients is that it is our endeavor to beat the markets over a 3-year period. Even if over a short span of time within that period we are underperforming, but that can be by virtue of structure of the portfolio, by virtue of the markets. Our investment philosophy is such that whenever we are investing in one stock, we are investing with a mindset that over 3 years this stock will unlock value and it will reach the intended price target. So I'd like to mention that over the last 5 years, our PMS has compounded capital at about a 24% clip. Now, in this period, there have been bouts of volatility which the portfolio has had to endeavor. Now, for that reason, the longer the time horizon that an investor has, the greater is his ability to tide over bouts of volatility. And the shorter the time horizon, greater is the chance that he will get caught in a bout of volatility. So I would only say that clients who are looking to invest in equities or in PMSs should at least have about a 3-year time horizon to invest in equities, as also in PMSs. And they should have patience for that 3-year period. If one wants to have quick returns, and one believes that is the route to make those quick returns is equities as also the PMSs, then there is a high likelihood that they will be disappointed in their expectations. So we would just say that a 3-year time horizon is what an investor should have in mind before investing in equities. Until then, an investor should be patient.
Right. Thank you so much for your time.
My pleasure. Thanks.